Gold has always been considered a safe investment. For centuries, people believed that no matter what happened in the world, gold would always keep its value. Wars, inflation, stock market crashes, gold was always there as a safety net. But in 2025, something unexpected happened. Gold prices suddenly dropped. Hard. And people around the world were left asking, what's going on? In this video, we'll break down the reasons behind the sudden fall in gold prices. We'll explain it in simple language, without technical jargon, so you can understand exactly what's happening and what it means for you. Whether you're an investor, a gold buyer, or just curious, this is something you'll want to know. Let's get started. At the beginning of 2025, gold was trading at around $2,100 per ounce. That's a pretty strong price, close to its all-time highs. But within just a few months, it dropped below $1,700, a fall of more than 20%. That's a huge move for something as stable as gold. In the financial world, a 20% drop means we're officially in a crash. So, what's causing this dramatic fall? Let's break it down step by step. One of the biggest reasons gold prices fall is because the US dollar gets stronger. Why does that matter? Well, gold is priced in US dollars around the world. So if the dollar becomes more valuable, it takes fewer dollars to buy the same amount of gold. In early 2025, the U.S. economy showed surprising strength. Inflation cooled down faster than expected, the job market remained strong, and interest rates remained high. All of this made investors trust the U.S. dollar more. When people trust the dollar, they move their money into it. As a result, the dollar's value goes up, and gold's value goes down. Let's talk about interest rates, because they have a big impact on gold. Gold doesn't pay any interest. It just sits there. So when interest rates are high, people prefer to put their money into things that do pay interest, like bonds or savings accounts. In 2025, the U.S. Federal Reserve decided not to cut interest rates as early as people had hoped. Investors were expecting rates to go down, which would have helped gold go up. But that didn't happen. Instead, rates stayed high. That made other investments more attractive than gold. And many investors pulled their money out of gold and into bonds or savings. This shift in investor behavior pushed gold prices down even further. Another factor behind the gold crash is the stock market recovery. When the stock market is rising, people feel more confident about taking risks. They're more likely to invest in stocks and other high-return assets rather than safe havens like gold. In 2025, several tech companies made a comeback. AI, renewable energy, and biotech sectors showed strong growth. The Nasdaq and S&P 500 started climbing. Suddenly, gold didn't seem so exciting anymore. People rushed back into stocks, and gold took another hit. Around the world, central banks play a big role in the gold market. Countries like China, India, and Russia often buy large amounts of gold to store in their reserves. This helps stabilize their economies and protect against currency risks. But in 2025, something unusual happened. Several central banks either slowed down their gold purchases or sold some of their gold holdings. Why? Because some economies needed cash. Others wanted to support their own currency. And some simply believed gold had peaked in value and wanted to cash in before prices fell further. These large sell-offs put even more downward pressure on gold. Gold is often called a fear asset, meaning people rush to buy it when they're scared. Whether it's war, inflation, or a stock market crash, fear pushes people toward gold. But in 2025, despite a few global tensions, there wasn't a major crisis. Inflation came under control. Global growth started to return. The energy markets stabilized. People were no longer as fearful, and that meant fewer buyers for gold. When there's less demand, prices naturally fall. Rise of cryptocurrencies again. Believe it or not, Bitcoin and other cryptocurrencies are competing with gold. Some investors, especially younger ones, now see Bitcoin as digital gold. In 2025, Bitcoin made a big comeback. It crossed the $100,000 mark again, and that got everyone excited. Institutional investors, hedge funds, and even some governments started pouring money into crypto. As a result, gold lost some of its shine. People saw more potential in crypto assets, which offer higher returns and are easier to trade globally. This trend shifted investment away from gold and contributed to its decline. Supply chains and mining output. Another factor that's often overlooked is the supply of gold. In 2025, gold mining companies ramped up production due to the high prices in previous years. This added a lot of new gold to the market. At the same time, demand didn't increase to match the supply. More gold and less demand equals lower prices. Simple as that. Some mining companies also sold large quantities of gold to cover their debts and operating costs, which added even more supply to the market. Gold ETFs and paper gold selling. Many people today don't buy physical gold. Instead, they invest in ETFs, exchange-traded funds, that track the price of gold. These are known as paper gold investments. In 2025, there was a massive sell-off in these ETFs. Investors pulled their money out, either to avoid losses or to invest elsewhere. As a result, these funds had to sell real gold to cover redemptions. That created a feedback loop. The more they sold, the lower the price went. If you've invested in gold, or you're thinking about it, you might be wondering, what should I do now? First, don't panic. Gold has always been a long-term investment. Yes, prices are down now, but they've dropped before and recovered. The key is to understand your goals. Are you buying gold for safety, for profit, for diversification? Second, think about dollar cost averaging. That means buying small amounts over time instead of all at once. This can reduce your risk and give you a better average price in the long run. Third, keep an eye on the factors we talked about: interest rates, the dollar, stock market trends, central bank activity, and crypto movements. These will give you clues about where gold is headed next. Absolutely. History shows us that gold often bounces back after a crash. Here's why. Economic uncertainty can return at any time. Central banks may start buying again. Inflation may spike again. Interest rates may eventually drop. And geopolitical tensions can still trigger a flight to safety. All of these could drive gold back up in the future. Gold may be down, but it's not out. The 2025 crash surprised many, but when we look closely, the reasons are clear. A stronger dollar, high interest rates, a stock market rebound, and a shift in investor behavior. If you understand the causes, you're better prepared for what comes next. The key is not to react emotionally, but to stay informed, stay patient, and think long-term. Whether you're holding gold, thinking of buying it, or just watching from the sidelines, this is a story worth paying attention to. The gold market may be quiet today, but it always has a way of surprising us. Thanks for watching. If you found this video helpful, make sure to like, comment, and subscribe. Let us know in the comments what you think about the gold crash. Are you buying, selling, or just watching? We'd love to hear from you.